Well, it's a great time to be in Minnesota. I just always am honored that you asked me. I never know that I ever listed a pleasure to come to Minnesota in January. But I have to say that there's a whole lot more optimism in Minnesota this week than there was last week. I mean, I read in the paper yesterday that after Sunday that even Lutherans are becoming optimists. So it sounds like it's nothing but up for the Minnesotans here. We're going to start a GoFundMe campaign for that Saints defensive back since he's probably out of a job. So anyway, it is great to be here with you. There's lots of things going on in this business. You know, if I had to characterize any kind of an outlook session right now, it would be there's a whole lot of everything, okay? If we look at grains, if we look at proteins, if we look just at any, the supply is not a problem. We have a huge amount of just about everything available, but it's been pretty remarkable what's happened on the demand side in the last 12 months, really 10 months. And the question is, will that keep going? I was in South Dakota last week, and Joe Kerns said, well, what was the mood in South Dakota? And I said, well, I think everybody was walking around just pinching themselves, just trying to make sure that this is still real. I did change outfits here recently. Have joined Kerns and Associates. I'm so new that I don't know how to spell the name yet, but we're going to figure that out. And it's good to be with Joe and Karen and Dave Delaney and Carl Hoffman and all the others. We've got a pretty good team that I'm looking forward to working with. So I'm not doing anything different. With my departure, EMI didn't have anyone on staff that could really serve as the consultant for the pork board as I had done at EMI, and so I'm still the consultant economist for the pork board and for National Pork Producers Council. I have, since we're affiliated as an introducing broker with FC Stone, I have to put all this legal stuff on this slide right here. So you got that read, right? Okay, let's go. All right, macro conditions, good but not great, but better. I mean, we just kind of keep chugging along on the macro side. Third quarter GDP. The president got his 3% quarter-to-quarter growth. Year over year, that's just a little over 2%. I think that's a pretty good rate. Now, the president thinks we ought to have more than that, and we probably will in the fourth quarter. We think fourth quarter GDP could be up as much as 4% because hurricanes really tear things up, and it really is a stimulus to the economy when you start rebuilding after those things. And so that could cause GDP to go up pretty dramatically here in the fourth quarter. But still, it's kind of steady as she goes. I don't see this thing getting very robust, but it's one of those get rich slowly situations from a national income standpoint. 2 to 3% growth rate to me is a very good growth rate. I don't know if the politicians will leave that alone. January through, and I should have put January through November, growth of real personal disposable income grew just 0.4%. That's kind of take-home pay, but October was up almost 1%. That's the last month that we have data for so far. And so this is an important move, in my opinion. This is total personal income divided by population, deflated to a base year, so you take out the impact of inflation, and that's after taxes. Personal income is after tax payments are taken out of it. This is the one that hadn't grown very much, and really I'd been kind of looking at it and going, how is demand this good without more growth in real personal disposable income? And then October comes up almost 1% growth year over year. Now that's still not robust, but I think it's kind of the first part of a wave here. The labor market has tightened so much in the last couple of years that we've been looking for some growth in wages, and we just haven't seen it. If we look at employment growth through October, 7 months so far this year, 200,000 plus. December was 148,000. The average of the year was almost 170,000 added to the employment rolls per month. This is the 7th straight year that we've added 2 million to the employment rolls. So the labor market is getting tighter, and now we've got 4.1% unemployment. And so at some point, the price of that labor should start going up, and we're starting to see that now. We think that's one of the real positive things for meat demand as we go through 2018 that we'll see. And then there's this wealth effect. It was the day before yesterday, the Dow went through 26,000. Our population has more people exposed to the equity markets now, and more people are aware of their exposure through 401ks or self-employment retirement plans or whatever it might be. And so when this happens, I think it has more of an impact on the outlook of consumers than it did in years past. I mean, at one time, my father never watched the stock market because he didn't have anything at stake in the stock market to speak of. All right. Now, generally, he was a blue collar worker, and so he didn't have much there. But more and more of our population respond to this, and so it makes us, if nothing else, it makes us feel good. And when we look at the measures of consumer attitudes, they're the highest they've been since 2000. So the Consumer Confidence Index, the Consumer Sentiment Index, and you can see in the background is the unemployment rate, which is clearly negatively correlated to these consumer outlooks. So we have a lot of consumers out there that are feeling pretty good about things, and if they get a little more money in their pocket, we think that could be pretty positive for demand. And we think that's one of the things that's really being traded, maybe over-traded, by the futures market right now as we look into 2018. On the meat side. So we'll talk about that in a moment. It's not going to be a supply issue, that's for darn sure. Here's 18. We've got, this is just 4 species. If you see the USDA figure of 223 and change, that includes veal, lamb, and a little bit of other poultry. We just have 4 species in this. The record was 200 pounds, pretty much right on the nose in 2006. And any of you who've been here for the last several years, you had some guy up here telling you, we'll never get back to where we were in 2006. Which the lesson there is never say never, okay? Because it looks like we're going to do it. We're probably going to do it in 2019. I think we're going to get back very close to 200, maybe above 200 pounds. We're going to be at 188 and change this year, probably 218 and change this year. So very close to that figure. What this proves is, and I really did, I think my never statement was based on reasonably good logic. I mean, we have a population that was following a lot of animal welfare issues, and we're fighting animal welfare issues, and we're Meatless Mondays and cultural things about animal treatment and animal use. And I thought, with these young consumers coming along, we probably would never get back up there. One thing we did notice as we've gone through this, and I've mentioned it many times, is that while everyone is really concerned about consumer attitudes toward animal welfare and animal rights, I wasn't ever seeing it in the demand measures. I mean, one of these videos come out and all the producers get their hair on fire, and all the packers get their hair on fire, and the animal rights activists get their hair on fire, and the consumers out there went, okay. They didn't pay any attention. They don't care. What they want is good quality meat protein at an affordable price. And when we got this thing back to an affordable price, they're buying it. And they're going to buy as much per person as they ever did come 2019. So that's positive. I mean, that's a positive. Demand is pretty good. Now, quantity is just one part of demand. The other part, of course, is real prices. And this is deflated meat prices on a monthly basis from USDA, and there's all kinds of warts and foibles of this data series, but still it's a good, consistent one. And notice that these retail prices for pork are hanging in here up in the $3.60 to $4 range, where they used to be in the $3 to $3.60 range. And they're just kind of staying in there in spite of how much we're bringing to the market. It seems like we're being able to maintain those prices. And there are some folks that say, well, we need those prices to come down so people will buy more. Well, they're buying all we make right now at that price. Why should you reduce the price? And do you think you're going to get more for a hog if you can get less for a per pound of pork at the retail? And the answer is probably not in the long run anyway. So any business wants to push up the price of the product that they're selling. Okay? They want to be able to extract more value, and I think we've done that. Now, we've gotten some help. Look where beef prices are. So beef prices are still high relative to pork, so we have a little advantage there. Of course, chicken prices just continue to go down. A very efficient industry that can price this product very low. And so we have to fight this one. We're gaining some from where beef is. When we put price and quantity together, we get real per capita expenditures. And that's been a really good story for the second half of this year. We had a tough first 2 or 3 months here. This is beef, pork, and chicken. We don't put turkey in here because The USDA's turkey price is not very good. It's just a whole bird price, and it really is pretty misleading. But you can see we had tremendous growth of consumer level demand in 14 and 15. It backed off a little in 16, but we've stayed kind of on this uptrend here, especially in the second half of the year. When we look at the separate species, pork is in the upper left. We dug ourselves a huge hole in January and February, and we continually just climbed out of that. We're down 1% year to date. I think that's remarkable that we can stay at that level, given the level of supplies that we placed on the market this year. We're up at about a little over 50 pounds, almost 51 pounds per person on per capita offerings. Beef, kind of the same kind of story. Not a very good first half of the year, a pretty good second half. They're still lagging a bit, and chicken has just been right on its 5-year average all year. So they're down about 2.5% for the year. But still, this is a story of gaining ground as we've gone through the second half. The other part of demand, of course, is exports, and that one has been very, very good this year. When we started the year, we had 4% growth on our forecast for exports this year. We weren't the most pessimistic out there. There was some at 1. We weren't the most optimistic. Millie Haley and the ERS folks at USDA had 6% on their growth. They win because that's where we're going to be. We're going to be a little better than that. We're up 7.8% year to date through November. December appears to have been a very good month for exports. We think it's probably going to be just off this, but November was record high. We're up about, like I say, close to 8%, 5% growth there. If we look at individual countries, we've had growth in a number of these year to date. Mexico up 14%, Japan 1%, Korea 30%. Here's where we were in November. A little recovery year over year for China, Hong Kong, but that's because a year ago really sucked. And so, you got to always be careful about what you're comparing to. The important lesson to learn from this chart, though, is the uptrend. That uptrend is Mexico, and it's the only one of those top 6 countries. You can put a little uptrend in other markets here in the last couple, 3 years, but longer term, it's the only one with a significant uptrend. So that underscores the amount of risk we face in the current climate over NAFTA. I mean, this is our largest growth market. They're our largest muscle market, and this is just muscle exports. They are our largest pork byproduct variety meat market. They're not our largest value market. That would be Japan, because Japan restricts imports basically to high-value cuts because of the gate price mechanism. But still, as far as growth markets, this is the one. And we shouldn't be doing things to mess with that, in my opinion, and I hope we end up there. The president obviously is involved in this, and we don't know what's going to happen. But I think he's absolutely right that a 20-some-year-old trade agreement should be renegotiated from time to time. I don't think we probably should walk away from that, and I think he's smart enough to figure that out. We'll find out for sure as we go down this road. I do know there's a lot of pressure being put on him by farm state legislators and all of the livestock and meat groups certainly have been very vociferous about trying to impact, and by the Secretary of Agriculture. The Secretary of Agriculture is fighting this fight for us, and that bodes well, I think, for us as we go forward. If we look at one of the things we watch very closely, of course, is exchange rates. It has really gone in our favor in Mexico this last year. Last fall, one of the real kind of confounding things was we had 2 record months to Mexico in November and December at a time when the peso was devaluing rapidly. And, that on first blush, that doesn't sound very logical, but if you're sitting there with a currency that you know is going to be worth less next week than it is now, what are you going to do? And especially if you're seeing product in the United States at, 5-year lows that might go up next week relative to where it is now, you're going to go ahead and buy. And that's what they did. They bought before the buying got worse. So that was the surge last fall. But since then, the peso's gained some value. It lost some value late in the year, but still they're playing with a currency that's worth somewhere in the 10% range, more than it was at the beginning of the year, and so that lets them be a much more effective competitor for U.S. product. Other currencies have been pretty steady this year. You don't see much change in any of the other currencies of our major customers. Okay, so exports, positive thing. The value of the dollar is important. We were just talking this morning on our morning conference call about where does the dollar go. If you look at dollar index futures, which we kind of watch as a general barometer of the dollar, that's weighted pretty heavily toward the euro, about 48% in that index fund, in that index calculation. It broke a major support line this week. That would suggest that it could go down another 5 or so points from the 90 level down into the 85 level and weaken the dollar, and that would be really positive for export businesses like us. Now, I'm going to say wait and see on that because we've been in this 92 to 101 trading range for the better part of the last 2 years. So on a couple of occasions we broke out the top side or the bottom side of that range and we got right back in it. I don't see a lot out there that would say the dollar should weaken, given where we are. But getting a tax program behind us puts a little more confidence there. I think it's worth watching. We think the dollar will probably stay kind of in this range as we go forward, and that's kind of where we'd do the forecast is somewhere in that 92 to 101 range on the dollar index. Okay, on the grain side, we had the final USDA report on the 2017 crop last week in the WASDE report. That came out. The USDA reduced acres slightly. They increased the yield per acre to a record 176.6. That left the crop unchanged. When we go down into the usage, they changed usages just a little bit less on feed and residual, a little bit more on ethanol, on seed and industrial. As we come down to the bottom, 2.477 billion bushels projected carry out at the end of the year. That adds up to 17% of total usage. That puts us way out, and I'll show you in just a minute on this relationship of supply to price. But certainly a little more pressure on price as we go forward. If we look at grain consuming animal units, here's the red line. This is a USDA data, except for the last one, which is computed by FC Stone, very high number. And notice where corn feed usage is. So what has happened here is when ethanol comes along and we start reducing the amount of corn that's available for livestock feeding, guess what we who feed livestock and poultry did? We figured out how to feed other things. And so now corn has come back, and yet we've been able to push grain-consuming animal units in relationship to corn far higher than it used to be because we have systems in place to feed alternative products to these animals. And I think that's going to continue. We don't have to push corn prices up to keep GCAUs going up. Now, there's a limit out there because there's only so much grain sorghum and bad dog food and bakery products and all those things that we're using on an ongoing basis now. There's only so much of those out there, so there is a limit in this space that can be created. But the point is, we're not really beholden to the corn business at the present time. Part of this is a very slow start to this crop year on exports. We think that's going to continue. We've got very good crop conditions in Brazil and Argentina right now, and every day you read something that somebody's trying to talk that crop down to be smaller. But when you look at the weather conditions and moisture conditions, it probably isn't going to happen. We think there's going to be very, very good crops in South America. And here's this relationship of stocks to use to price. I mean, this is the highest stocks to use ratio we've seen since the 1990s, the early 1990s. And what does that mean? It means that corn prices are going to be about as low as we've seen them. And we don't think that there's much end to this. I mean, with that size of carryout, one short crop here won't put us back over here. It might put us in here around 4 and a quarter corn, 4.5 maybe. But I don't think there's a big disaster in here unless we have two short crops in pretty much in a row somewhere in the world. Two short crops in the United States, one in the United States, one in South America, right back to back. Those could have an impact of moving us back up in this $5 plus range, but we don't really see that happening. We think the odds of that happening are pretty slim. So here's the forecast, and this comes from our friends at EMI who I work for. This is the forecast, and we would concur with this. If you take nearby corn futures and just use that as your price series, somewhere in this 350 to 370 range, kind of as far as the eye can see, and so that's a very positive thing for the business. On the soybean side, the January WASDE, again, very few changes here, a little bit reduction in yield, a little reduction in the crop, but still a carryout of 470 million bushels. There were some folks thought that it could be as high as 500. That gets you to 11% stocks-to-use ratio. Just as in corn, the season got off with a very slow export pace, which has gotten slower relative to the last year as we've gone through January. And if we take the stocks-to-use, we're not nearly as far out here as corn was, but still we're down here in the $9 to $9.50 range or so on beans. And that puts the forecast for bean meal somewhere in the low 300s, again, kind of as far out there as you can see. And the same thing here, that you'd have to have 2 short crops in a row to really impact this and drive this cost up. So what does that mean? Well, as of last week, the futures that were on the board at that time, 61.66 average cost of production for 2018. Now, this is Iowa State University's production parameters. When I look at that and I compare it to other cost estimates around, Iowa State's parameters would represent the probably best 10 or 15% of producers out there. An average would probably be $4 higher than this. But still, if you look at futures right now, you can't find a futures price on the board for this year that would have a loss in it. So very good outlook for costs here. Obviously, individual farms are going to have production issues and those kinds of things that will impact this. But as an industry, we're looking at the lowest cost of production since back in 2007. And so a positive situation, certainly, if we got lower cost of production, we can bring consumers a product at a more reasonable price and still make money all the way through the chain. And so this lays a real good ground, kind of a foundation for where we're headed here in the next year or so. Competition, again, of course, EMI very big in the chicken business, and Eric Stoller provided these for me. Their outlook for 2017 and 18, for 2018 is for very modest growth, 1 to 2%. All of that being in bird numbers, no growth in weights. They're still fighting the woody breast problems and trying to modify end weights to try to take care of some of that. There's a genetic component that they've got to work through on that. But still modest growth. Now, the thing to remember, though, I think there are 5 broiler complexes currently under construction. There's only 2 of those that are going to be up and going by the end of 18, and they'll just be startups. The rest of them come on in 19. So we could see more growth on the broiler side in 2019 than what we've seen in 2 or 3 years here, because they've been operating at capacity, basically, for the last 3 years. I mean, you had to build more complexes to get more production, and they're doing that right now. We're going to see some increase going into 19. These growth in output, though, has allowed them to sell breast meat cheaper and cheaper. And there's a couple of other components to this. I mean, just like you, they don't really care where the value comes as long as the value gets there to make their business work. Breast meat obviously has been a big issue back in the, one of their major consumer products, but there were 300 plus wing concept restaurants built last year, and there's somewhere in that or near that number planned for this next year. The last time anybody checked, there's only 2 wings on each chicken. Okay? And so that means that wing prices have gone up, and a lot of the seasonality is gone out of wing prices. I mean, wing prices used to peak in December and January around the football bowl games and the Super Bowl, and then fall off a cliff. They don't do that anymore. So they're carrying more value than they used to. The other one is that we've seen a pretty good rebound in leg quarter prices. They were just dirt cheap, basic giveaway down in the 20 cent per pound, 20 to 30 cent per pound range. They're up in the 35 to 38, bumping 40 cents a pound. That's nothing to write home about, but it's a big improvement when you can put that back on the value of that bird. Okay, and they've had a major, what I think is a pretty important product development. More and more of the chicken plants are putting in boning lines for thigh meat. And, I'm not a huge chicken fan. I eat chicken sometimes. I know. Yeah, I have to admit it. But I can change, I guess. But But this boneless thigh meat product is pretty good. I mean, you throw that on the grill, it's way better, in my opinion, than breast meat. And it's just one that's, I think, going to start bringing more value back to these leg quarters. We're seeing more and more of it in the United States, and so that would leave them keeping that product on this market and, again, carrying some of that value. What does that mean for breast meat prices? It means low-cost competition. All right. So if a housewife or a grocery shopper, whoever they may be, walks in and is comparing pork chops and breast meat, we're going to have a tough sell here, okay? Because breast meat is not going to get very expensive. All right, on the cattle side, the numbers are the important one. Here's our forecast. This is a forecast, David Weber at EMI. Notice what his quarterly forecast for slaughter increase for cattle are in 2018. 5.5%, 6%, 3%, 4.2%, and that comes off of a year averaging 5.1%. So in 2 years, 10% higher cattle slaughter. I mean, we're on the backside. We're finally getting calves out of all those cows that went back in the cow herd in 2013 and 14 after the droughts of 2011 and 12 reduced the cow herd dramatically. And so we're going to have more and more competition here. You're going to start pushing cutout values down, well below $200 down in the, and start being very competitive. If we look on production, you add a little bit of weight in there and you even get a bigger number. 5.6% is David's forecast for this year on the beef side. So I think the thing to take away from competition is not a lot of competition, increased competition on the chicken side this year, but some product mix issues. On the beef side, just we're going to have more beef. And so that's going to probably pull those retail prices closer together and not leave us quite as good from a competitive standpoint. All right, hogs and pork. The world situation, production forecast by Foreign Ag Service to grow 1.8% this year. It's been basically flat for 5 years. So that's going to have some product availability increases. Now, if you look at country by country, where are those increases coming? Well, the lion's share of them come in the place where you would expect the lion's share of them to come, China. They have 50% of the hogs. They change anything, and we see a big increase there. The other one is the United States. No other major producer is forecast to grow other than Russia, which is on their own kind of little plan to be self-sufficient. But Brazil's pretty flat. The EU is flat to down as we go into 2019. So most of the growth is here and in China. Now, there's my dollar index chart. Well, we're not going to talk about that now. Okay. Quarterly Hogs and Pigs report came out in December. An interesting report because due to the timing around the holidays, they release this report while the markets are open. Normally, the Hogs and Pigs report comes out on a Friday after the markets are closed, and everybody gets to sit and think about this until Monday. In this case, though, it came out with an hour left in the trading day. It was just about as expected. Here's the average year-over-year percentage from pre-report survey of analysts. Here's the numbers out of the report actually, and notice very little difference. There's just not much there that would expect to move markets. And if anything, it was a little bearish, maybe on the deferreds, because these numbers were a little bit larger. And so what did the market do that day? It went up. And then it went up again the next, on Tuesday after Christmas, when it traded. Sometimes you don't know. And that was kind of a surprise to us. We thought this was a neutral to maybe slightly bearish report, especially on these farrowing intentions. Now, when the farrowing intentions actual differ from the expectation, you have to ask yourself, what happened here? Right, when they differ by that much. That's a big difference. And what has happened over the last 3 years is that USDA has notoriously been low on these intentions. In 11 of the 12 quarters going into this report, the actual farrowings for a given quarter were larger than what the intentions had been the previous quarters. So USDA was missing to the low side all the time. And there have been a few of us that have been a little critical of USDA on that and said, guys, you're missing all the time. If I'm missing by 1% all the time, I know how to fix that. I add 1%, okay? It's pretty easy. It looks like they kind of recalculated here. And they did this a year ago on the pig crop and the pig inventories, when their estimates came out much larger than any of the pre-report estimates, and they really did recalibrate the report, and they've been pretty close since then. I think that's what happened here. As a matter of fact, we use these farrowing intentions. We think they fit with the breeding herd of up 1.1% and some productivity gains. They also went back and they revised the breeding herd, which they hadn't done in, golly, Lawrence, how long has it been since they did a revision on a breeding herd? 20 years? They have just stuck with their number all the time. And this time they revised the last 4 quarters because their farrowings per breeding animal were getting out of whack. And so some good work, I think, by trying to get the report a little bit recalibrated here going forward. We thought these numbers were pretty reasonable. Pigs per litter up 1.1%. This is record large for the quarter again. And that's something we'll just, it's just going to happen. Here's the breeding herd. Now, what those revisions mean is that instead of growing by about 0.7% from 2009 through 2015, now we're growing by 1.2%. So in the last year and a half, that cranks this growth rate up. And everything we hear in the countryside with new sow units being built, and you never hear about sow units going out. We know that there are a few that are going out, but still, we think this growth rate is probably here for the time being, at least, especially with as positive as markets are. Pigs per litter, as we pointed out, record large here on this final quarter. Our forecast, the normal kind of seasonal for the next year, would be more records coming, and so we've got pigs per litter up about 1.5% as we go through 2018, which will add to our supply totals. And then all that adds up to a rising number of market hogs. The December report was right in here at about 65.5. That's record large for December, still well on this trend line. And I put this up to make a few points. First, there is no hog cycle in this chart. You see this little variation, but it's all within a year, so this is seasonal variation. There is no hog cycle there. There hasn't been really a hog cycle from a production standpoint since the late 1990s. We basically are just a steady growth industry. That hog cycle, 4 years peak to peak, or trough to trough, isn't in this chart. The only major deviations from trend in this have both been animal health situations. The first one was here when we got circovirus vaccines, and we made a lot of pigs live to market weight that used to die before they ever got out of the nursery. Okay? So a big jump in pig numbers there. Thank goodness the Chinese were standing there buying all that pork in 2008, or it would have been a real wreck. The other one, of course, is PEDV. So one of the conclusions you make is that I don't think we'll see a lot of variation away from these trend lines unless we have a severe animal health situation. And that's one of the reasons as you go through the winter, we're all kind of going, how bad is PRRS and how bad is PEDV? And I know that there's all that talk been going on in the last 2 weeks. And it's going to continue because we don't have a real good answer yet. The University of Minnesota data would say, not too bad. Now the guy that has PEDV thinks that the world is crashing on his head. And he tells everybody about it. Okay? So the guy that doesn't have PEDV doesn't tell people. So we have this kind of biased selection in our conversations about animal health situations that you have to be careful about. But still, the data says that that's what's going to affect our output. By the way, how did we handle this little introduction right here? We took 500,000 sows out of the breeding herd. I mean, just that fast. Now, higher cost was part of it. The corn prices were high right then. But I would argue that the fact that those sows became so much more productive due to circovirus vaccines was a big driver of why we took 500,000 sows out of the breeding herd. We just didn't need them anymore. Okay? So if we ever get a solution for PRRS, we'll see the same thing happen again. Frozen pork in freezers has been a pretty good story all year. Of course, one of the reasons is we haven't had hardly any bellies in the freezers, but we've been tighter. It's growing. But a big drawdown in November, larger than normal, in fact, about twice as large as normal in November. It's very positive. We killed record numbers of hogs in the month of November and yet drew down cold storage stocks twice as much as we normally do. That's a real positive story going forward. Our forecast for slaughter based on the report, we've got some big growth in the second half. over 4%. We got 1.7, 3.3 in the first two. Now, part of this fourth quarter one is one extra slaughter day in the fourth quarter of 2018. So that adds to that number. But for the year, we think we're going to be up about 3.5%. You can see where the Livestock Marketing Information Center and Dr. Lee Schultz at Iowa State are. The LMIC is a little lower than us. It doesn't look like they have any kind of adjustment in their fourth quarter numbers. But still, 126 million and change would be where we are for federally inspected slaughter for 2018. If we look at price forecasts, this table is a little bit old because I've had some transitional problems, but I went back and the only thing that would have changed would be these futures prices. And we just go pull the futures prices as a comparison to our cash forecast. Now, my cash forecasts are basically fundamental analysis on supply. We basically assume that demand is going to be where it was last year. What kind of impact would supply changes have on the price of pigs? When we do that, we come up with prices in the mid to upper 70s for the summer. As of yesterday, the second quarter would be about $80 on the futures on average. That would be April, May, June. And if we look at June, July, August, it would be about $82. The fourth quarter would be about $68. Okay, so that gives you a comparison of where just plain fundamental analysis compares to where the futures are now. What does that mean? Well, it means that the people trading futures are looking at either significantly higher demand or significantly tighter supplies, or they just have more money that they can throw at this thing and they're going to push it up. Now that's possible because we have fund involvement here that tends to come into these, and we think that that's probably a pretty good number right now, and they're normally on the long side of the market. We think that these are some real opportunities out there. Could they go higher? Absolutely. I think that's possible. And if we do have some any kind of severe kind of animal health situation this winter, then those summer contracts could be priced lower. That's the reason we're recommending, look at the summer using some option strategies that would leave the top side of this market available to you, but still we think that the market's offering you some great opportunities to price hogs relative to where we think. And you can see we're way more optimistic than LMIC and pretty close to where Lee is down at Iowa State on where we think prices are going to be in the summer on a cash basis. Again, the futures are trading beyond that, and I always find it hard to argue with futures because those folks are betting real money on that deal. And I'm not putting any real money behind mine right now, okay? So they're serious about this, and I think it deserves our attention. And certainly we think that there's some opportunities there for pricing hogs. If you look at slaughter, this is the graphical presentation, weekly slaughter of those numbers I showed you, a projection for 2019. Here's the new packing capacity. Now that would have the plants full on one shift. That's what this number represents, and they're not full on one shift yet. If we look, and we've been very close to these numbers so far, just in the first couple of weeks of the year, we could see record slaughter numbers again in the fourth quarter, and again challenging packing capacity come the fourth quarter of this year. The Prestige plant is supposed to be open somewhere right in here. We don't think that they will be slaughtering enough pigs to matter a whole lot on this question as we get into the fourth quarter. We look at weights. This is weights through early December. They ended up the year just about at this same number. We certainly backed up some pigs in September and again here in November. It didn't account for the shortfall in numbers that we saw during that time period. If we look at the packing capacity, of course the big jump was in September when we had these plants open. As we understand, the Triumph Seaboard plant has come into some challenges in ramping up their throughput, and they're at about 8,000 a day. Clemens plant in Coldwater is somewhere above that number. They think they will be filled. They said in February, and I'm not sure they're going to get up to their 10,000 or 12,000 head per day level by that date. Triumph Seaboard, the last I heard, it said they're still going to try to double shift sometime in late spring or early summer. I haven't heard anything different than that. And so if that comes along, then of course we'll get another kick up to about 20,000 head there sometime in the fall or early of next year. This whole thing, about 8% increase that we're working with now on total capacity, when the Prestige plant opens the fall of 2018 and really becomes a factor in 19, we'll have 10% more slaughter capacity than we did in the fall of 15. And all these things are good. I mean, that's one of the reasons you've seen cash hog bids as strong as they've been, is these plants are using pigs. Now, the two plants I'm talking about there, to my knowledge, have not bought any hogs on the open market, or very few, but they pulled hogs that used to be on the open market or were going somewhere else and left someone else bidding hogs, and so they've had a positive impact on cash hog bids. If we look at pork production, of course, it looks a lot the same as slaughter, and again, record large for most weeks of the summer and into the fall, relative to last year, which were record large, and then a projection for 2019 that will put us well above 600 million pounds a week in the fourth quarter of 2019. And weights, here's the weight chart you saw a while ago that showed you through the fall, and now they're about 2 pounds, about a pound heavier right now. We think that weights will go up pretty dramatically, maybe by 1 to 2 pounds most of the weeks this year relative to a year ago. We think that weights have really been influenced over the last 2 years mainly by changes in production practices. Less ractopamine, that's created some tightness of finishing space. We think we've caught up with that some, and we're going to go back to growing weights, especially with feed costs as low as they are. So our forecast for weights are about 1.5 pounds heavier on average in 2018 than they were in 2017, and we have more growth than that on them for 2019. Here's the belly one, and this, of course, this caused bellies to be extremely high last summer when we ran these stocks down last spring. The belly thing, I've been trying to predict belly prices, and I got to get a new dartboard because it doesn't work very well. They're really lots of volatility. We built some belly stocks. We've traded them back up into this $1.40, $50 range. Anytime they get that high, we're going to start pushing back down on them and start putting them into the freezer, I think. We look at futures. This is a ladder that goes back to September of last year. October is where we bottomed out, and this thing has just kept climbing. The last one I have on here is December 1st. If we had today's prices, of course, you saw them a while ago, it would be up here in the mid-80s for the peaks. December would be here at about $68, so above the highest line that we see here. And I think we're going to probably trade that even higher as we go through the spring. We normally, that complex moves up as we go through the spring of the year into late April and into May. Profits, based on that run last week of lean hog futures, corn and soybean meal futures last week, $30 ahead for 2018. That's the second best year of the last decade. Of course, second only to the PEDV year where we shorted the market and ran prices to record levels. You're not going to get any reduction in the breeding herd when you got $30 a head profit out there. Now, this is for the best producers. Probably average producers will be somewhere in the $20 to $22 head. The cutout value we think is going to trade up toward $90 this summer, but will be under some pressure as we go into the fall relative to a year ago. 2019, we think we're going to have some pressure virtually all year with a peak somewhere in the mid-80s. Bellies, here's that roller coaster I talked about a bit ago. And, you know, if you say, well, gee, it's been on such a roller coaster, why is your forecast so steady? And that's because I'm not a very good forecaster. There's not much you can do on this because it's hard to find what the trigger is that sets this bar off one way or the other. What has really happened is that we've seen interest for featuring that got caught short and had to chase bellies higher. The prices stopped the featuring and they went down, and then they got back down here around $1 a pound, and off we went again. And those concerns got caught short again, and we had record prices. And then what the cure for high prices is what? High prices. And so when high prices went up, they went down. We got it down to about 90 cents last fall. We've traded it back up in this dollar range, and we've seen a little blip down and then back up as we've gone through 2018. Loin primal continues to basically fall relative to history, carrying a smaller and smaller proportion of the value, the cutout value. That's been going on for about 10 years. The ham primal's been pretty strong. It's mainly driven by Mexican business, and we think that that's going to continue this year. Butts, again, the pulled pork thing has really helped butts over the last 5 years and continues to do so. Picnics, we think, will be decent as we go through the second half of the year. Okay, risks. Major export disruption, always number one. Very low probability, but monumental impacts. If we had 24% or so of our production that tomorrow could not go overseas, we'd have to find a price to clear the market. Trade issues, the biggest risk we face right now, I think your guess is as good as mine. The folks at MPPC are kind of on this 24/7. That's their number one objective, is to try to keep us in the NAFTA and keep us in the Korean Free Trade Agreement at terms that are favorable to us. The EU did a free trade agreement with Japan a few months ago. That goes into effect January 1, 2019. It's basically the same deal that we negotiated under the TPP agreement. This is a big deal. The Trump administration said, well, we don't like these big multilateral trade agreements. We want to do bilaterals. And that's fine. But we haven't got one done yet. And so it's time to get off whatever portion of your anatomy you're on and get these things done if we're going to do them. I have no problem with that philosophy, but we have a major competitor that has an agreement with Japan, and I haven't heard any talk about us getting one. Finally, the U.S. deals on other bilaterals within TPP and those kinds of things. We haven't heard much on that. Labor, most of you are dealing with the risk of the labor situation. And there's more risk when they talk about DACA and they talk about fundamental immigration reform, a big deal. The plants have been, as far as we know, they've been okay as far as labor goes so far. Triumph said early on, Triumph Seaboard, that they had enough labor for their first shift. They haven't said anything about a second shift, and I know that the labor situation in that Sioux City area is pretty tight. The same would be true in Michigan, we believe, but we'll see what happens on that. But labor certainly is an issue. And right now, I could throw another one in here, kind of an enforced labor, kind of a backdoor labor situation of what's going on with trucking. The electronic data loggers hasn't, in fact, reduced the supply of drivers because it limits the hours that they can go. Now, we have gotten a waiver on the live animal side, I think until March on this thing. There's a lot of issues. Of course, the people that wrote these rules didn't think about something being alive in one of those trucks. They thought everything was in a box. And so we got some work to do on that. But we're seeing some real impacts on the meat side of these plants right now on getting enough trucks to just ship product out. The EDL regulations are already impacting the supply of trucks and causing some very large overages to be paid on some of these shipments going out of plants. So that's kind of a backwards deal on labor, but in effect what it does is reduce the supply of truck drivers and thus the supply of transportation services. Diseases, PEDV is good. We've had some PRRS outbreaks. I know of a PEDV farm in Iowa that got positive results yesterday on a PEDV test. Not a huge farm, not a huge operation, but still a significant one. So there's some of this around. If you watch the University of Minnesota publication each week, which is a terrific job that they do, their PEDV sample represents 3 million sows, half the sows in the country, basically. And they had 0 cases of PEDV on those farms 2 weeks ago. Now, we'll get last week's data on Friday, so we'll watch these pretty closely. But again, this is this kind of reminds me, I've said, several years ago, someone would say, oh, PRRS has killed every pig in Iowa this week. And I would go, nah, maybe it's not quite that bad. And it never was. But obviously the people that are hit by these diseases, we hear about that, and we don't hear about the ones that had it last year that don't have it this year. Okay? And so that's kind of the offset here. And I watched the Minnesota data pretty closely. It ain't the gospel, but it's as close as we've got. And so we're very close to normal. I mean, we just not very far off of where we were a year ago or the last 2 or 3 years on either one of these. And if anything, the PEDV one's actually a little better. Feed costs, 2 crop failures to match 12 and 13 costs. We think that's there, and we think the probability of this is pretty low. Now, one thing I would say, if you look at the drought monitor maps, they don't look very good right now. We've gotten significantly drier. I know for both acres of corn in Oklahoma, we have had half an inch of rain since October. So we're dry going into this spring a little bit, so it bears watching. Demand, will we see growth this year? I think it's very likely. With wages picking up a bit, consumer incomes are going to be there, consumer attitudes are positive, prices are going to be good. I mean, we're going to offer them product at a good value. So I think we could probably see that. Preferences, we've kind of gotten past the animal fats phobia that we had, and we've all been enjoying that the last 2 or 3 years. If that can continue, we always have to kind of watch our flanks on things like nitrates and the cancer organization and those kinds of things on processed meats, but preferences seem to be very strong. Exports, what happens to the U.S. dollar? Mexico, of course, the NAFTA is part of it, but the other part of it is expansion of the Mexican business. They're in the midst of a major expansion, probably 15% or so, maybe 20% over the last year plus the next 2 years. They're in that right now. They're not done with it. Smithfield's building a packing plant in Mexico. We just approved imports of product from Mexico this last week, saying that they're free of classical swine fever. Now, I don't think there's going to be a flood of product from Mexico into the United States. My guess is along the border there might be with some specialized products, but I don't see them being real competitive with us in that market. But if they grow, they're going to keep low-value products in Mexico, and they have a free trade agreement with Japan. So my guess is that they're going to ship high-value products to export markets and compete with us in both markets pretty effectively in that manner. So I think this bears watching. Finally, the trade issues we talked about. And finally, the big risk to the long-term well-being of our business. What happens to pork prices if we fill the plants in 2019 and beyond? You saw our projections for 2019, and they were big increases. And they're only based on about 1%, 1.1% growth in the breeding herd, 1.5% growth in the litter size, modest changes in exports and imports, okay, and another 2 pounds or so on weights. All of those are pretty reasonable, and it puts you at very high production levels come 2019. Questions? I'll put the price forecast up there just to, always a good background for questions. Yes, sir.
Are you comparing everything, ISU and yourself, to the CME prices? Are they converted, when you say cash?
I'm using, these futures are just the futures prices. This would be the national net price of all methods. We try to make this as confusing as possible. We all forecast a different price, okay? So that's the reason I put the history in here. You can see that this one generally runs higher than the national weighted average base price, okay? So this is that series USDA report. This is just straight futures. I don't have any basis in there, okay? I think that answers your question.
Yeah, just looking at the USDA recently, their projections they put out every quarter, they've got a very low target for the summer.
Well, and they quote live prices. So you need to remember that. These are carcass. Yeah, they're pretty low. I agree. And I wouldn't, yeah, they're lower even than we are. Probably not a lot of risk takers working at USDA. Okay. I like them, and Millie Haley does that work, and she's a wonderful friend. But they're not going to climb out on many limbs. Yeah.
With the stock market at 26,000, what effect or impact would, we have a market correction of some amount? What is the relationship to consumer perception about how they feel they are in life versus their spending habits, and what's that mean for them?
Well, I'm going to run back to that. I got to go way back here on this one, don't I? Getting close. There we go. Well, you see what happened when we hit the big recession here in 2007. They went right off the face of the earth, okay? And they did it pretty much in 2000. Now, they don't go down as much or as quickly as they did on that one. Of course, that was not your normal kind of recession. I mean, that's a big risk. That's the reason. I mean, we've got really good consumer attitudes, and that means people will spend money. And if you had a major, I guess what a correction is 20%. Is that right? On the stock market? I can't remember the exact definition. That'd take it back down toward 20,000. I mean, that'd be a big correction, and so you're going to see a significant reduction in consumer attitudes, and that would bring us to a recession. Now, with that said, some of you in this room know Bob Dealey. Bob Dealey runs an outfit called No Spin Forecast in Chicago. He's a real economist. He's one of those macro guys that understands all that GDP and inflation stuff that us ag economists kind of went right over. But Bob has a model that he has developed over the years that uses, kind of real-time data to predict, 9 months out, and it has a very good track record of predicting recessions. And his model doesn't have one on the horizon at this point within 9 months. So, the relationship between some interest rates, the relationship between inflation rate and the unemployment rate, that all goes into this model that he has. So, it could be a significant turn for sure, and that market is not going to go up forever. I mean, there's no guarantee that. We know that this recovery is the second longest ever, and so, we're going to have some adjustment on that at some point. And when it comes, I would say that if I laid the real per capita expenditures up here, you would see some correlation between meat demand and these consumer attitudes. So that's a concern, no question. And again, there's more of the population that pays attention to and has direct stake in what happens in those equity markets now than there used to be. Others? Yeah.
What are you hearing on sow herd health in Canada?
Sow herd health in Canada, I don't know. Somebody from Canada can help us with that? Sow herd health in Canada?
I was at Banff last week, Steve. There wasn't much talk.
Okay. Yeah, I wasn't. Go ahead.
Was the PED cleaned up?
That was out in Alberta, and they got the PED cleaned up. Okay. I have not heard any talk, so that kind of tells me that there's probably not much going on. But yeah, Banff would have been the place you'd heard about it. Yeah.
With the expansion of the sow herd, is there any talk of expanding packing capacity for cull sows?
I have not heard anything about that, and I would be surprised if it happens because there's excess capacity in the sow slaughter sector now. There has been for some time. We have plants that kill 4 days a week most of the year, so you could add another day on those and handle any sows you have. I don't think we're going to see an expansion of the sow herd that's going to really test that at any point. If I'm in the sausage business, I'm still trying to find something else to make sausage out of. Okay? Thanks a lot. I'll be around a little bit. I think I've got to go do some interviews over with the media guys, so I might be down in that corner of the trade show if you need to talk to me. Thanks.